Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, March 30th at 1 p.m. Eastern, so let's get after it. In the past month, we've experienced a full bear market down 20% and a full bull market up 20%. Of course, this volatility follows a period of calm during which we observed some of the lowest volatility readings in history. As noted by famed economist Hyman Minsky, the onset of a market collapse can be brought on by the speculative activity that defines an unsustainable bullish period. This is known as the Minsky moment. Sound familiar? If one accepts that the fourth quarter of 2019 resembled more of a speculative behavior driven by liquidity rather than the fundamentals, the Minsky moment conclusion is not only compelling, but hard to refute. Without a face to blame for the recession and the common enemy of the virus that everyone wants to defeat, there are no governors on the amount of monetary or fiscal stimulus that will be used in this fight. As an example, our economists now estimate a U.S. fiscal deficit of 18%. A level last seen during World War II. Recessions don't just appear out of nowhere. No matter what the exogenous shock is that ends in expansion, the conditions for a recession must be in place for that trigger to actually work. More specifically, every expansion leads to excessive credit creation. This time around, it was into corporate credit and shadow banks, which are unregulated financial intermediaries, something I discussed in last week's Thoughts on the Market. The recession usually brings the most pain to these areas of excessive credit and leverage. However, given the extreme response we are now getting from the Fed and Congress to fight the virus, I envision less pain than normal for the bad actors of the last cycle. This is why I've been getting more bullish the past few weeks, even though the economic and earnings data are sure to get worse. There are several reasons we think the lows for this bear market are likely in. First, recent lows were made during what can only be described as forced liquidation by the levered players, i.e. the shadow banks. It's hard to imagine the kind of liquidation that we just witnessed in March could happen again, given the lower leverage today. Second, this past week, credit markets stabilized thanks to unprecedented support from the Federal Reserve and other central banks. After the past 10 years, we have no doubt in their resolve to stabilize both the funding and credit markets. Third, economic and earnings data will be grim over the next month, but equity markets may have already discounted these revisions based on our valuation work. And finally, from our hundreds of conversations with clients over the past few weeks, there's a strong consensus for lower lows on a retest over the next month or two. While that doesn't mean the consensus can't be right, we would remind listeners that we never got a retest on the December 2018 lows, which happened under a similar type forced liquidation. The bottom line is that a Minsky moment and a health crisis have elicited an extraordinary policy response. We believe excess leverage, both in corporate credit and the shadow banking, is why this move has been so ferocious. With forced liquidation now behind us, unprecedented monetary and fiscal support, and the most attractive valuation we've seen since 2011, we stick to our view that the worst is behind us, and current levels are probably good buying points on a 6 to 12 month horizon. We're not saying it's a straight line up, and a pullback is likely at any time. However, our base case is that the lows are in for this bear market for most stocks, and that makes the risk-reward more attractive today than it's been in years. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.